Well, good afternoon and welcome to HYROX's weekly webinar, where we are going to talk about what we see happening in the global economy, in financial markets, and in the world of wealth management, and how all of this impacts our decisions on the best courses of action for our and your investment strategies. We invest our money in the exact same models as our clients, and we think that this defines the true nature of our prudent and disciplined investing strategy. Our discretionary management enables us to make quick decisions and execute them immediately for all of our clients simultaneously, which is especially important in volatile markets as we take advantage of the opportunities that avail themselves to us. I am Scott Tomlinson, and my partner and colleague Paul Tepsich, the founder of HYROX, is also with us, as is our financial planner and wealth forecast specialist, Bianca Tomlinson. We are recording this webinar so that those who can't join us live can tune in when it is more convenient. If you are a first-time listener and would like a little bit more information about our private client services and our disciplined investing strategy, we have a separate introductory webinar that will provide you with this on our website under the Private Client Division tab. Well, as we do, and I know this is a bit repetitive week to week, but we want to continue to make sure that we're on top of our themes for 2017. We think that our strategy of having a tactical perspective to investing becomes even more important this year because of the even greater levels of uncertainty imposed on us by a number of developing factors. Inflationary expectations are rising, but not as fast as many had anticipated after the Trump election. Well, higher interest rates will increase the costs of borrowing, and increasing debt levels present us with a whole new set of risks. It is expected that earnings will grow at an approximate rate of 10% in 2017, and this has been revised down from about 11.5% at the beginning of the year. However, price-to-earnings ratios are at a 14-year high, suggesting a little bit too much optimism in stock markets at the moment. Well, let's wait and see on details from the Trump administration at the moment, but of course tonight Trump will be addressing Congress, so we should get a little bit more information. We'll see what happens there. Brexit may cost the UK over $60 billion. It remains to be seen how the new populist revolution plays itself out in the upcoming elections in the Netherlands, France, and Germany, but it is all creating a great deal of uncertainty. We'll come back to these latest developments on these issues shortly. When we began our advanced approach to portfolio management back in 2015, we added a third model to the standard buy and hold balanced portfolio of equity and fixed income to try and find a way to add value to client portfolios by reducing risk and maximizing risk-adjusted returns. Now, our style is to wait for opportunity and be tactical about how we take that opportunity. Now, if you had bought the global equity ETF a year ago from 100% cash, you would have experienced a close to 22% increase in the value of your investments. But if you were bought in 2 years ago and held on, only a 3.5% return. So you can see how a tactical strategy can be a benefit. The longer you're in, the smoother the curve, but at what risk? The higher the price, the higher the risk that it may move lower. Well, bond returns have been minimal in the last couple of years, and a combined and balanced portfolio, the benchmarks after fees, have had lower than average returns over the last 2 to 3 years. With a more risk-oriented approach, getting a higher return for the amount of risk taken, our clients have had lighter short-term returns, but well above average longer-term returns. So we tend to focus more on the longer-term average returns. And so does Warren Buffett, for that matter. In his annual Berkshire Hathaway shareholder letter, he railed against the fees that hedge fund and portfolio managers charge and suggested that over the past 9 years, that an S&P 500 ETF had outperformed them with an average annual return of 7.25%. Now, our balanced client is better than the benchmark indices by over 3% after fees over the last 4+ years, with an annual average return better than 8.5%. But as a reminder, historical returns are no guarantee of future returns. But at High Rock, as you all well know, we work very hard to provide our clients with the best possible risk-adjusted returns. We also believe that it is crucial that we review your wealth forecast on a regular basis so that we can ensure that your long-term goals are in line with your portfolio strategy and our forecasts for your net worth into the future are up to date and heading in the same direction as your goals. Well, on the inflation front, inflation data remain below target on a global scale, although they are inching up in the United States a little bit more. We will see the U.S. Federal Reserve's target personal consumption expenditure core price index data tomorrow for January, so we'll get an update on that. But at the moment, we don't see any policy changes at the central banks. However, the odds of a rate change at the U.S. Federal Reserve have increased to about 38% for their meeting on March 15th. Well, after 4 years of commodity price deflation, prices have been rising since early 2016, but have stalled recently, and they were a little lower over the last week. U.S. consumer spending was stronger than initially thought in the final months of 2016, though the overall economic growth trajectory remained muted amid downward revisions for business investment and government spending. Gross domestic product, a broad measure of the goods and services produced across the economy, expanded at an inflation and seasonally adjusted annual rate of 1.9% in the fourth quarter, the Commerce Department said Tuesday. Now, that was unchanged from the initially reported figure. The forward-looking data collected by the Atlanta Fed suggests a 2.5% growth rate for the first quarter of 2017. On the week, the U.S. bond yield curve has flattened, led by a drop in 10-year yields. And we'll talk about that a little bit more as we progress, but lower bond yields and higher stock prices are putting that relationship in a state of flux. As we've said since the beginning of the year, historically correlated and non-correlated asset classes are not showing their normal tendencies. Investors have been borrowing more now to invest in U.S. stocks, and that certainly has been driving U.S. stock prices to their current levels. Well, in Canada, total consumer price index jumped to 2.1%, but the core measures that are key to the Bank of Canada remained well below their 2% targets. And that means that they won't be raising interest rates anytime soon, and certainly not at tomorrow's meeting. For borrowers, this means that staying variable remains a good option. 10-year bond yields were also lower in Canada this week. In Canada, stock prices have actually followed bond yields lower recently. On the earnings front, expected earnings for 2017 have been reduced from 11.5% year-over-year growth, which was at the beginning of the year, to currently 10%, and that's down another couple of basis points over what we reported last week. The S&P 500 price continues to rise on Trump and global economic optimism. But looking forward, prices continue to outpace expected earnings. And with lower earnings expectations and higher prices, the price-to-earnings ratio has jumped to 17.7 times, its highest level in 14 years. The 10-year average is at 14.4 times. This means that earnings will have to grow by about 20% more than currently expected to bring the ratio back to its 10-year average, or the S&P 500 will need to correct by 20%. You have to ask yourself if you want this kind of risk in your portfolio. Another of our metrics of value, enterprise value to EBITDA, also shows stocks to be as expensive as they were at the time of the dot-com bubble back in the turn of the century. On the geopolitical front this week, President Trump addresses Congress tonight at 9, as I suggested earlier. He is expected to be more upbeat relative to his darker inauguration speech. And we're all waiting for specifics, but we don't think there will be much, just a broad repeat of his goals on tax reform and replacing the Affordable Care Act. Now, on Monday, President Trump said nobody knew that health care could be so complicated. And the European Commission President, Jean-Claude Juncker, has suggested that the price tag for the UK on their Brexit might be close to 60 billion US, as I mentioned earlier. And French voters go to the polls on April the 23rd, and unless one pulls more than 50% in the first round, they will return on May 7th to decide between the two frontrunners. A dominant figure in the campaign has been far-right leader Marine Le Pen, who has benefited from claims of financial wrongdoing, which have swirled around the campaign of her center-right rival, Francois Fillon, since late January, culminating last week in the announcement that a magistrate was launching a formal inquiry into the claims. Current opinion polls give her a lead of several percentage points over Mr. Fillon and centrist Emmanuel Macron, though both of her rivals are predicted to beat her in a two-way runoff. So here at High Rock, with all of the upheaval, we will continue to monitor event risk and price valuation, and we will add or reduce holdings in our models as opportunity presents itself, and by preparing our strategies with continued deep levels of research as we did last year and the year before, keeping in mind that our tactical approach allows us to add value and reduce risk to give us the best possible risk-adjusted returns. Now, we did some trades in mid-November that involved selling fixed-rate perpetual preferred shares and buying fixed-rate reset preferred shares to coincide with long-term interest rate adjustments. After a decent move in some of those securities, we are now taking a little bit of profit. And Paul, I don't know if you want to add to that at this point in time.
Trying to take some profits in at least one of these, I think, that has an implied credit spread that has rallied very substantially over the past month alone. So I do have some offers out, and we'll probably get filled. But I think it's still a really good trade. Just want to take a little bit of profit off the table.
Nothing wrong with that.
Nope. You don't go broke making money, Scott.
Absolutely. And perhaps your chart of the day, Paul, bonds leading other financial markets. Did you want to make a comment there?
Oh, yeah. This is the, maybe it's a little bit complicated, but it's what's called in the U.S. Treasury bond market, the government bond market. This is the 2-year versus the 30-year spread. And as you can see on the far right side, it's at 176 basis points spread between the two bonds. And that's really pretty well the full spectrum of the bond curve. And what this signals is that the 30-year part of the curve, the back end, people call it, is actually rallying. Having moved down from basically early November post-election, the curve steepened enormously out to around 205 basis points, and we're now back in by about 30 basis points, and in fact, to where we were pre-election. So, you know, there's a lot of talk about the Trump reflation trade and whatnot. If the bond market, you know, and Scott, you say it all the time, usually on this call, bonds lead other capital markets. And the fact of the matter is that this 30-year bond does not look like it's overly concerned about inflation. So the bond market, again, is telling us something here. We best pay attention.
Excellent. And I'm just going to, for the purposes of some of our listeners, the spread that you're talking about between the 2-year and the 30-year bonds is what the difference between the two yields. So a 2-year yield and a 30-year bond yield, there is a 1.76% differential there, and that's the 176 basis points that you were mentioning. I just wanted to make sure we were clarifying that for some of our listeners. All right, and we have some administrative things to talk about today. Bianca, I'll let you take over here.
Thank you, Scott. All clients with non-registered accounts have now been sent their 2016 management fee summaries, as well as their realized gain loss reports and their Raymond James tax slip mailing schedule. I just want to remind clients that T3 slips are not scheduled to go out until the end of March, so you can expect those in early April.
And anybody who's made an RSP contribution in the beginning of 2017, they should be able to have those by sometime in the mid-March to the third week in March, right?
That's right.
Okay, excellent, excellent. Okay, well, thank you for that. If anybody out there listening has a question on any of the tax slips that you're expected to get, obviously we're always available to guide you through that, but hopefully we've given you as much information as you need for now, and if there is any issues that you have, please don't hesitate and get in touch with us, because we want to make sure that we get all of your tax documentation to you in time for your filings. Okay, that's it. As always, we want to thank you for taking time out of your busy schedules to tune in. If anybody listening has a question, I would certainly take it right now. Okay, no questions today, but if you have any questions or concerns, please certainly feel free to email them to us. We will be back with our next update next Tuesday, but until then, this is Scott Tomlinson, and on behalf of my colleagues Paul and Bianca, we want to wish you all a great rest of the week.